Welcome to this episode number 112 of Your Next Trade. Code today, Trump versus too late Powell. So market is doing the same, grinding higher and higher and higher. Same kind of conditions, a bit less of memes, but as we're going to see, we are going into the most busy week of the year with tons of catalysts in the next 5 sessions. But let's start with a bit of the American show that started again on Thursday when Trump visited one of the Fed building just to check that everything was running well. So over the last couple of months, Trump has been criticizing publicly Powell, saying it was too late, that the Fed should be cutting rate aggressively, that we are 200 bips or 2% way too high for the rates. And what is going to be happening is actually next Wednesday, we got the FOMC meeting where the Fed is expected, unfortunately for the Trump administration, not to be doing much. So that's going to be, you can make sure that on Wednesday, if the Fed is not moving, that Trump is going to be sending tons of tweets saying that the Fed, again, is too late. But overall, what we have is the same market conditions. Where if you look at the week-to-date asset performance, the stocks, S&P 500 up 1.5%, Japan up 4.1%. Why? Because they have the 15% tariffs with the US, but as well we had the election a week ago, and clearly what Japan is going to do, like the rest of the world, they're going to do some stimulus and running high deficit. So this is the story these days. We got stocks in the light blue that are going higher. We got actually looking at the euro, looking at the dollar that is kind of moving sideways, a bit weakening on the week-to-date basis, where we are trading around 117, 118 versus the euro. Bitcoin flattish, but some other cryptos, as we saw last week with Ethereum, making new highs. Why? Because there is a ton of inflows going into Ethereum due to the stable coin. So stable coin is going to get bigger, the same as Bitcoin. This is just allocation to this asset class. You have less volatility, but really the trend is higher with passive flows going into that space. WTI down on the week and copper up. So what about the week-to-date industries performance? So right hand, as you can see, not many industries that are down on the week. Regional banking, airlines, bank. So a bit of profit taking for the banking system, but overall, as you can see on the right-hand side, home builders that have been doing very well. So on one hand, you get the macro numbers that are telling you that the housing market is not really moving. Why? Because the 30 years mortgage is still very high, because a lot of Americans refinance in 2020 at very low levels. So there is not much of an incentives for going into new homes. And this is why as well Patient and the Trump administration wants the rates to go lower to restart the home builders. But what we saw around midweek is actually some decent numbers in terms of earnings from that space. So overall, as you can see, if you look at the S&P, that is roughly halfway, you do have like half of the sectors industry that are doing better. And if we look at the sector's performance, looking at week to date, as you can see, healthcare, that was the underperforming for the year. So there's a bit of a catch up. So like the memes before, now all the underperformers that we had before are now catching up. So on one hand, you can say that this is a broadening of the strengths of the US market. And on the other hand, you can argue that that might be the end of that trend where people are running out of ideas and buying the losers, the underperformers. So overall, strong week again with the S&P up 1.5%. What about the rates? So 4.4% for the US 10 years. I want to flag the most important one. This is for Japan. Looking at the 10 years for Japan, up 7 bips, and we are now at 1.6%. So this is the same picture that we have across the world, around the world, where yields have been pretty high and going higher. Why? Because many countries, mostly all the developed countries, are running deficits. And that means, again, two things: that we might see inflation picking up again. That is the first thing. And the second thing, that we have tons of bond supply that structurally is going to come in the next few years, meaning that to meet that supply, to meet that demand, you need a pretty higher yields that you had some time ago. So we are in a different world than when we were where we were obviously 5 or 10 years ago, when the cost of financing both for governments and companies is much higher. So let's look at the Fed's funds expectations with the Fed fund rates that is for the next meeting. So this meeting, the expectations are clearly for no change. So it's like 99% no change for this meeting. So the too late Powell is probably going to be late again. What is the next cut going to be expected? We are talking probably, September. There is a chance. We are roughly at 60% chance that the Fed will be cutting. But what is interesting, if you look at the last versus the 18th of June 2025, why did I use the 18th of June? Is because it was the last FOMC meeting. And as you can see, the two lines are more or less the same. So what does it tell you is between the two FOMC meeting and a lot of noise from Powell, a lot of noise from the market, actually the expectations are exactly the same. So no change, a lot of noise, no change. And in the meantime, the market is grinding slowly but surely higher. Actually, it's more than slowly when the market is up 1.5% for the week. VIX, and this is the same picture as always, where when you have compression in volatility, market going higher. So now 30 days implied volatility is below 15%. We've been done quite a lot for the week, from 16 to 15%. And as we're going to see later, it feels more and more like the market is done pricing any moves, at least in the next 10 days. Everything is going to be fine, that the earnings season is fine, that AI is good. And we get very low volatility environment. I just want to go through one chart and no more than one chart. That is, let me open that and give you that chart for the S&P futures. And we don't want to be doing more than technical analysis for the week. Why? Because the picture is really the same. As you can see here, this is for the S&P futures. You see the trend that started from 2020 onwards, last 5 years. And we are grinding higher. We had this massive bounce from the 48.50 level now, and you see this kind of move. This is the same chart that you take tons of stocks from Roblox to Robinhood. They all be looking the same. Where you're trading above the 20 days, the 10 days, all the moving averages, and the trend is the same. So I'm not going to be spending too much time on this. It feels a bit like, obviously, there is a bit of over extension, but as always with this market, it can go much further. So let's talk about what is happening for the week, and I want to flag first thing first, the earnings season. So this is here. This is for roughly 500 companies out of the 3,000 that you have in the US. So that's roughly 20%. And as you can see, there is an interesting thing, which is the sales that you have here. So companies versus the let's say the most recent earnings season have been beating sales by quite a lot, 2% more than the 1% something. So really the change is about the sales, where we are much higher. So companies have been beating the top line. In terms of earnings, this is pretty much the same versus the last 7, 8. So roughly what you have is 60% of the companies will be beating sales, but instead of beating by 1% something, they will be beating by 2%, and 80% plus of the companies will be beating the earnings. So overall, pretty good earnings season. We flagged 2 weeks ago that the expectations were lowered quite a lot. So the quarter on quarter was 4%, and it's going to be much higher than this. So as usual, we lowered the expectations, but overall, that translates into the market that goes higher and higher. So we had some earnings. So that was some Google on Wednesday, where the market, kind of liked it. And overall, again, companies are doing pretty well in the US. The expectations are for 2026 to have this stimulus coming from the big beautiful bill, that you're gonna have AI that is kicking even more. So as we saw with Google on Thursday, on Wednesday, sorry, Google announced that they will be increasing their capex for the year by roughly 10 billion or 10%. So all the Google, all the AI capex is going higher, meaning the theme and everything that is around AI is doing pretty well. And in the meantime, if you look at macro, to the flash PMI is doing okay. And finally, as always, we have tons of retail traders that are betting on the 0-day to expiry on a very short dated strategy. So we are talking, the call mania, we are talking the meme mania, we are talking the retail mania and the short interest mania. And one of the good example was open this week. So as you can see here, this is the chart on the right hand side. This is for the share in dollar terms, and left hand side you do have like the number of calls. And as you can see, when there is an army of retail traders that are moving and going into calls, we are talking $3, $4, $5 strike with very short data, that pushes the stock much higher. And that has been the playbook that started roughly in 2020, 2021, as you remember or not, with GME and some AMC. And this is what we have been seeing overall, where the market is doing the same. So we are kind of, so away from what we had 3 months ago, where the expectations were, we panicked on the tariffs, saying, if we have tariffs, even like 10% is going to be pretty bad. And the market, came down by 20%. And now we are 10% higher than when we had the tariffs announcement. But in the meantime, now the average tariff is going to be at 15%. So a bit of hard to understand, but this is what is happening. Market is keen on pricing higher multiples. We are talking 22 to 23 times now for 2026. So what about this week? This is the most busy week of the year. We got tons of things from macro. So let's start with macro, with what are going to be the drivers for the week. So we got the GDP on Wednesday, where the expectations are for plus 2.5%. We get the core PCE on Thursday, and we got the job market with the NFP on Friday, with as well the ISM PMI manufacturing, not only for the US, but for the rest of the world as well. So very busy week in terms of macro. Second part is obviously the earnings season. And here, this is the most busy week for the earnings season, where we're going to have big names like Meta, Microsoft, we got Amazon. So this is obviously for the fabulous 7, but you have as well a bit of across sectors and across industries. We started with the banks and with financial, so we're going to have less financials, but overall, a big day for the oil sector, for the energy sector. On Friday, we get some names like Visa, Starbucks. So really, really busy week. And we have, as I said, the NFP numbers on Friday, where, as you can see, most recently, the move, if you take aside the big move that we had with tariffs, is roughly plus minus 0.9% over the last, say, 12 to 18 NFP number. And finally, again, we get the FOMC rate decision that we should be linking as well with the Bank of Japan and the Bank of Canada. So expectation for the FOMC meeting on Wednesday, as I said, is no change. Bank of Japan, this is one to be looking at, because due to the carry trade, there are many positions that could be unwind. So tons of catalysts, as I said, FOMC, macro, earnings, and as well, this is the end of the month. So that means from the 1st of August, we could have the new tariffs in place. We do know that Europe is talking to the US. What we ticked so far is, if you look at the three blocks, we are talking China. China is still talking, and it feels like there have been progress. You look at the second block, which is Europe. This is ongoing conversation, and Japan agreed for a 15% tariff. So overall, tons of catalysts, tons of chances that you could see some volatility. And in the meantime, guess what? The market is telling you, no, there's not going to be most of a change where the S&P weekly straddle. We are talking about what is the option market pricing in terms of move for the week, plus minus 1.3%. So volatility, implied volatility is very much compressed. The market is very okay and saying, you know, everything is going to be fine. Earnings season is good. We get enough visibility. We go higher and higher. As always, it's a bit funny because, you know, when you were like a couple of months ago, everyone was buying volatility and buying protection when VIX was at 25-30%. Now that you do have like cheap volatility, literally you could be buying the SPY protection for 1.3% for the week. No one is buying it. Guess what? As always, it's going to be ending in tears, but for the time being, this is what it is. So this is it for me for this week. Any questions on the 4x4 video series and or the mentoring? So I do know that some of you will be looking at starting the mentoring in September after the summer. So make sure that you reach out to me. If you want to join the trading community on Discord, we get a free channel and we get most advanced channels where you can have access to the mentors and to daily update and daily research. So I think it's pretty helpful. And finally, any questions, you can send me an email at greg@duponttrading.com. So overall, same market, we are grinding higher, a bit of broadening of the strengths of the market with a very, very busy week, both macro and earnings for this week. So this is it for me. Have a good trading week. Bye-bye.